Sole proprietorships, general partnerships, LLCs, corporations, and limited partnerships are different company types that exist in the United States. Each has its pros and cons. Some lack any requirements or filings to start, while others provide more structure and protection, thus require some formal steps to become official. A sole proprietorship is just a single individual doing business as themselves in their own name and is not considered a separate legal entity. Meaning, the law does not recognize a sole proprietorship as something separate from the owner as an individual. Accordingly, to begin a sole proprietorship, nothing has to be done. There are no required filings with the state government, and no EIN or tax ID is needed from the federal government. The owner simply starts doing work and begins collecting money personally. Money made through the business and any other income the individual earns elsewhere are considered all the same to the IRS. If I sell you my car through Craigslist or a fridge through Facebook Marketplace, I'm conducting business with you as a sole proprietor. A general partnership is also not a separate legal entity. It is not set up with the state and very often, too often, happens by accident. The easiest way to explain this is that a general partnership is a sole proprietorship, but owned by two or more people. So just multiple people working together towards a common goal and letting others know that the business exists. Everyone is still doing business as individuals in a group. The business revenue is treated as individual income for each member of the general partnership. The worst part about a general partnership is that all of the partners are liable for anything that goes wrong with the business, like debt or liability. To reiterate, anything that one partner does on behalf of the company, all partners are liable for. For example, credit card loans or debts. It's similar to think in terms of all the owners being married to each other. Both the good and the bad are shared equally. This is one of the major reasons that if someone is starting a company with a partner, it's super important to form an LLC or corporation as soon as possible. If they don't, they will automatically be classified as a general partnership, and then they're on the hook for whatever bad actions their buddy might have taken that costs the business thousands or hundreds of thousands of dollars. Don't think that'll happen to you? Why even take that chance? Let's move on to what we're really here for. Separate business entities. The main thing to note is that when formally setting up your business entity, it's not a single filing one and done. Setting up a business properly is a bit more like a fast food combo. The burger isn't complete by itself. You need fries and a drink, maybe ice cream. In the same manner, different elements of a business require different paperwork. The state needs a filing, the IRS needs a filing, and there needs to be a written agreement between all of the owners and operators with how things work. Who's responsible for what? And who owns what percentage of the business? All of the entity types I'm about to discuss work similarly because they're rooted from the same idea, which is creating a vessel or machine outside of the individual or individuals to run the business through. That being said, they each have nuanced differences, which we'll talk about separately through deep dives. But here we're going to focus on the necessary elements to get them set up properly and the different terminology each have for the same core elements, like what to call an operator versus an owner. So let's go. A limited liability company, or LLC, is a separate business entity. The law considers the business to be separate from the owners, whether that's one individual or 100. This separation, which acts as a shield, sometimes referred to as a veil, means that in almost all cases, the owners, called members, and the operators, called managers, of the business are protected if something goes wrong. Any and all losses stop with the company. There are a few key elements that are necessary to properly set up a new LLC. The state filing, which is known by different names depending on the state, is the document that legally establishes your LLC. For clarity, you set the business up with the state government, not the federal government. The federal government pushes that responsibility down to the states to handle because each state has its own rules, regulations, and taxes. This also means that if you are going to expand to do business in multiple states, you'll need to make multiple state filings when the time comes as you grow. Your state of origin is where you'll make what is called a domestic filing, and each state you expand to will need a foreign filing. By making this filing with the state, it is essentially saying, I, John Smith, am setting up a limited liability company and calling it ABC Tile LLC. Finito, the business is official. But even though the federal government doesn't want the responsibility of managing your business, they do want the taxes on the money you make. In order for an LLC to pay taxes to the IRS, have employees, or open a bank account, it needs an employer identification number, or EIN. Even if you're not employing anyone, you still need an employer identification number. It's just a poorly named term, which is common with government naming schemes, which is why it all seems so hard and confusing. It's basically just a social security number for your business that is given by the IRS. Remember that we said a separate business entity is almost like another person? Well, that person needs a tax ID, and that's what the EIN is. Federal Employer Identification Number, EIN, FEIN, Federal Tax ID are all interchangeable terms. They mean the same thing. An operating agreement is not filed with or obtained from the government. Instead, it's an internal company contract that outlines the rules of your LLC. It explains who owns the business, how the business is operated, how decisions are made, disputes handled, what percentage each owner has, and how the profits should be distributed. It tends to be a fairly long document, but at the end of the day, it's a contract between the owners of the business which explains the rules of the company. Too many people miss this important document or obtain one from the service they use and just toss it aside. You get that document out right now, sign it, and make sure all of the managers and members have a signed copy. Do it right now. LLCs are the easiest to set up and manage. They're the easiest to create clever ownership and payout arrangements with. They're also fairly new. Wyoming was the first state to allow for the creation of LLCs in 1977, but it took until 1996 for all 50 states to have them. So they're a fairly modern business type that solves for a lot of the restrictions corporations and limited partnerships were often hamstrung by. A corporation, while being a separate business entity like an LLC and having the same core elements, operates from a different type of structure, but importantly, also separate from the owners of the business. Here, the owners are called shareholders and the operators are called directors. To set up a corporation, a filing is again made with the state, which is usually known as the Articles of Incorporation, but again can be named any number of things depending on the state you file with. This is the agreement between you and the state that the business has been created and that it is separate from you as a person. An EIN is again obtained separately from the IRS for tax, employment, and banking purposes. But this time, the business contract or legal document that defines the rules of the company are called bylaws. A big difference between an LLC and a corporation is that unlike an LLC, which usually deals in ownership percentages from the moment of formation, a corporation must vote to create shares in a separate step with another internal document. Then decide how many shares each shareholder will receive. The benefit of this system is that it makes it easier to add new investors down the road without a lot of pain. Instead of having to recalculate everyone's ownership percentages when a new investor arrives, you just divvy out more shares, which naturally lowers the percentage of the existing shareholders. A limited partnership, or LP for short, is actually very similar to an LLC with a couple of caveats. In a limited partnership, there are limited partners, the owners, and general partners, the operators. The general partners are the controller of that partnership. They run the show. But the downside is those general partners are personally liable for all business debts and liabilities of the company, none of the fun and all of the danger. For that reason alone, it is not a very commonly used entity type. When a limited partnership is used as an entity, the general partner tends to be an LLC because that's the only way to shield from personal liability. But with this example, now you can see how hierarchies can be built by businesses owning other businesses, which creates for further liability protection. Any business can own many other businesses of any entity type. To set up an LP, a state filing is made, an EIN is obtained from the IRS, and the legal document that defines the structure of the LP is called a partnership agreement or agreement of limited partnership. There you have it, all the different ways to start a company with a little extra info. A sole proprietorship and general partnership are what happens when individuals engage in business without notifying the government, which is not usually recommended, while LLCs, corporations, and LPs are state-supported mechanisms to separate people from the businesses they're involved with. Is there something we missed or was hard to understand? Let us know below, but be sure to follow us for updates and more breakdowns of complicated business topics.